Welcome to Guru Crypto Garage.
What's up, Garage Nation? It is Friday, February 27th, 2026. And if you have been watching the news today and thinking what the actual hell is going on, you came to exactly the right place, because tonight the board is blinking, the headlines are stacking, and the suits on Wall Street are sweating through their Hermes ties while we are in the garage breaking down every single thing that matters for your money this weekend. I am Avatar John. This is Guru Crypto Garage, and we do not do confusion here. We do clarity. So let us build this engine from the bottom up, because if you do not understand the foundation, the macro, none of the crypto stuff makes any sense. We are going to teach you tonight real fast, no fluff. First thing you need to understand, there are three numbers that run the world right now. Write these down. Number one, the PPI. PPI stands for Producer Price Index. Think of it like this. Before a product hits the shelves at your store, somebody had to make it. The PPI measures how much it costs to make stuff at the wholesale level. It is the inflation reading before it hits your wallet. Today's PPI came in at plus 0.5% month over month. The experts, the PhDs, the Wall Street analysts, they said it was going to be plus 0.3%. They were wrong. And the core number that is everything except food and energy came in at plus 0.8%. Nearly 3 times the estimate. What does that mean for you? It means inflation is not dead. It is alive, it is inside the supply chain, and it is coming for your grocery bill, your car payment, and your mortgage, whether you are ready or not. Number two, the DXY. DXY stands for the Dollar Currency Index. It is basically a scoreboard for the US dollar versus other major currencies, the euro, the yen, the pound. Think of it like a leaderboard for the dollar. Tonight, the DXY is sitting at 97.6. That is down sharply. The dollar is weak. Now, here is the thing. Historically, and I mean for the last decade, when the dollar gets weak, Bitcoin gets strong. It is like a seesaw, dollar down, crypto up. That has been the rule. Tonight, that rule is broken. The dollar dropped 9% this quarter, one of its worst runs since 2011, and Bitcoin fell 15% anyway. Bitcoin is not acting like a hedge against a weak dollar right now. It is acting like a tech stock, like a high beta risk asset. High beta means when the market moves, this thing moves more, amplified in both directions. And that is a contradiction the garage is watching very carefully. Number three, the yield curve. The 10-year treasury yield, that is the interest rate the US government pays you to lend it money for 10 years, is sitting at 3.96%. The 2-year treasury yield is at 4.017%. The 2-year is higher than the 10-year. That is called an inverted yield curve. And every single time in modern history that this has happened, every single time a recession has followed within 12 to 18 months, the bond market is the smartest money on the planet. Smarter than the stock market, smarter than crypto Twitter. When the bond market inverts the curve, it is telling you loudly and clearly that it does not believe this economy is healthy long term. Now combine those three things. Hot inflation that will not die, a dollar that is weak but not helping crypto, a bond market screaming recession. What are the smartest institutional investors doing right now? They are running out of tech stocks. They are running into oil, into utilities, into industrial machinery. Let me give you the receipts. Since January 1st, 24% of all institutional outflows have come out of software stocks. The XLK, that is the technology ETF, a fund that holds all the big tech names, is getting absolutely smashed. Meanwhile, the XLE, that is the energy ETF, is up over 22% year to date. Utilities are up 13%. The suits figured something out. They figured out that the AI revolution, all those data centers running ChatGPT and everything else, they do not run on promises. They run on electricity, on copper, on steel, on water. So the smart money is not betting on the AI software companies anymore. They are betting on the power plants and pipelines that feed them. That is the trade of 2026 in traditional finance. And here is the proof. The equal weight S, P500, where every company counts the same regardless of size, is up nearly 7% this year. But the regular S, P500, dominated by the mega cap tech giants, is barely up 1%. That's 6-point gap is the entire story of this market. The mega cap tech monopoly that carried the market in 2023 and 2024 is cracking. And gold. Let us talk about gold, because gold just printed $5,250 an ounce, an all-time record. When gold rips like this here is what it is telling you. People with serious money are scared. They want something real, something physical, something that governments cannot print more of. Historically, tattoo this on your brain: gold leads and Bitcoin follows. When gold goes on a run, Bitcoin usually catches up with 3 to 5 times the leverage within 60 to 90 days. That is not a guarantee. That is historical pattern recognition. The garage sees it. We are tracking it. And we will tell you when that window opens. For now, the macro engine is running hot on inflation, running weak on growth, and running defensive on capital flows. But what is being built on top of that foundation tonight is where it gets very interesting. Hit that like button right now. Share this with somebody who is confused. We are just getting started. Now let us get into what dropped today. And what dropped today is not routine news cycle noise. What dropped today is the kind of information that changes the direction of capital permanently. These are the stories that 5 years from now, you are going to tell somebody about and say, I understood this before everybody else, because I was in the garage on a Friday night when Avatar John laid it out clean. So buckle in, because we are about to go wide open throttle on every single one of them. And I am going to tell you exactly what each one means for your money. First thing on the board, Morgan Stanley, $2 trillion in assets under management filed for a U.S. bank charter today to custody crypto assets. Full staking, full yield products, inside regular brokerage accounts. Let me translate this out of Wall Street English. Morgan Stanley manages $2 trillion. For context, the entire Bitcoin market cap is about 1.3 trillion. Morgan Stanley is bigger than all of Bitcoin combined. They just walked into the federal government and said, give us a bank charter, because they want to hold crypto directly for their clients. Not through a third party, not through a Coinbase custody arrangement, directly. Their own vault, their own keys, their own infrastructure, meaning your financial advisor's client who just retired can earn crypto yield without ever downloading a wallet or touching a seed phrase. This is not a tweet. This is not a press release. This is a federal filing. That is the difference between a car sitting in a showroom and a car with a title in your name sitting in your driveway. This thing is real. And here is the kicker. BlackRock is next. JP Morgan is next. Every major financial institution in this country just watched Morgan Stanley pull out of the pits first. The institutional tsunami that the bulls have been predicting for 3 years did not just make landfall tonight. It filed paperwork. Next thing on the board, the US government, specifically the Trump administration, officially labeled Anthropic AI a supply chain risk and ordered all federal agencies to stop using Claude, that is Anthropic's AI assistant, immediately. Anthropic is an American company founded by Americans, based in San Francisco. And the US government just reached into that building and put a label on them that they normally reserve for foreign adversaries. But then, and this is where the road splits completely within the same 24-hour window, OpenAI officially signed a deal with the Pentagon to deploy their AI models for military use. One AI company gets its engine seized at the border. The other AI company gets handed the keys to the most powerful military on Earth. This is a pit lane decision. OpenAI gets the military contract. Anthropic gets exiled. That is the Lockheed Martin F-35 decision playing out in real time in the AI lane. And now here is what nobody's talking about, but everybody should be. What happens to the researchers who just realize the government can shut your company down with a press release? They start looking for the car that nobody can impound. And that car is decentralized AI. These are AI networks that do not have a CEO. Tokens like TAO, that is bit and sore, where the intelligence lives on a blockchain instead of a server that a politician can point at. Fetch AI, Nosana. These are not meme coins. These are the underground garage builds for a world where AI censorship just became a documented reality with a federal stamp on it. Next thing on the board, Tether froze $4.2 billion in USDT. The largest single freeze in the history of crypto. USDT is a stable coin. Think of Tether as the fuel pump that keeps the entire crypto engine running. And today they pulled $4.2 billion worth of fuel out of wallets tied to hacks and scams. Tether just walked into every regulator's office on the planet and dropped a $4.2 billion proof of compliance on the desk. The stablecoin market just split into two lanes, and both lanes are accelerating. Next, SoFi, 13.7 million users just enabled native Solana deposits. SoFi is not a crypto exchange. SoFi is a bank where people direct deposit their paychecks, where people auto pay their rent. And now inside that same app, they can click one button and buy Solana. No new account, no extra verification. 13.7 million verified banking customers. If even 5% of those users touch that button, that is 685,000 new Solana participants from a single integration. One deal, one feature update. Now let me run through the rest. PayPal, MoonPay, and M0 launched PYUSDX. Any brand or creator can now mint their own custom stablecoin with one click. SpaceX is filing a confidential IPO next month at $1.75 trillion, the biggest IPO in American history. Elon at $1.75 trillion. Gold closed at $5,250 an ounce, all-time record. Safe haven demand is not a narrative tonight. It is a data point. And $8.7 billion in Bitcoin and Ethereum options expired today. Max pain was 75,000. We closed at 65. Post-expiry weekends favor the squeeze. Here's your synthesis. The suits are fleeing tech into oil. The government picked its AI champion. The biggest bank just filed to custody crypto. 13 million customers just got a Solana on-ramp. This is not a bear market. This is a shakeout. This is the moment where the weak hands get cleared off the track and the infrastructure for the next bull run gets built. The question is not whether crypto goes higher. The question is whether your position is ready before the next catalyst fires the engine. Share this right now. They will thank you Monday morning. Now, this is where we separate the real analysts from the noise, because social media tells you what the story is. The garage tells you what the money is actually doing, not the narrative, not the press releases, the actual on-chain behavior of the largest capital in this space. And right now, the data is telling a story that most people watching the price ticker are completely missing. Let me start with a number, 676,834. That is the number of Bitcoin sitting on Binance right now. The highest since November of 2024, a 15-month high. Why does that matter? When Bitcoin moves TO in exchange, it generally means someone is getting ready to sell it. When Bitcoin moves OFF in exchange, it means someone is putting it in cold storage in a hardware wallet, somewhere they cannot easily hit a panic button at 2. Think of it like this. Bitcoin on an exchange is a car sitting on a dealer lot with the keys in it. Bitcoin in cold storage is a car in a locked private garage with no sign out front. One is ready to move, the other is going nowhere. Right now, Bitcoin is flooding onto the dealer lot. 676,000 coins at Binance alone. $44 billion of immediately liquid supply that can hit the market any moment, any day. Now, the next number, 0.64. That is called the whale ratio. This metric measures how much of the Bitcoin flowing into exchanges is coming from the very largest wallets. 0.64 means 64% of all Bitcoin flowing into Binance right now is coming from the biggest players on earth. The last time this ratio was this high was 2015, during one of the deepest bear markets in Bitcoin's history. The people who have been in Bitcoin since the beginning, the ones sitting on generational unrealized gains, are moving their coins to the exchange. They have keys, they have access to liquidity, and they are positioning to use it. Now, here's the contradiction that the garage was built to find. While those whales are driving their Bitcoin TO, the exchange lot, the ETF complex is simultaneously buying through the regulated Wall Street wrappers. In the last 3 days, Bitcoin ETFs absorbed $980 million in net inflows. Back to back to back, 234 million, 373 million, 372 million. 3 consecutive days of institutional buying. the strongest 3-day streak in 6 weeks. BlackRock's IBIT alone pulled in $633 million over those 3 sessions. So you have 2 cars racing toward each other on the same strip. Force 1, Wall Street buying, Force 2, on-chain whales selling. What happens when those 2 forces hit each other head on at full speed? You do not get a winner. You get a wreck in the middle. You get a range, you get chop, you get exactly what we have seen. Bitcoin stuck between 62,000 and 70,000 for weeks. The ETF buyers are handing the spot whales a perfectly liquid exit. The accumulation is real. The distribution is real. And right now they are exactly offsetting each other in a Mexican standoff that the weekend is not going to resolve cleanly. Now let us talk about the dry powder, because this is the most important long-term signal on the entire board. The stablecoin market is at an all-time high. For context, that is bigger than the GDP of most countries on earth. $309 billion of capital sitting on crypto rails. But it is not in Bitcoin, not in Ethereum, not in Solana. It is idling. Monthly transfer volume for stablecoins just hit $10 trillion. 10 trillion moving through crypto infrastructure every single month. The engine is running, the car is in neutral, nobody is hitting the gas yet. And yet Ethereum's DeFi ecosystem, its total value locked, dropped from $75 billion in November down to $53 billion today. Capital is staying on crypto rails, but pulling out of the fast lane. It went into the service road, parked in stablecoins, hazards on, waiting for a signal. This is classic late correction behavior. Maximum dry powder, minimum deployment. When conviction comes back, and it always comes back, that $309 billion does not ease into the market. It does a full throttle launch, and the price discovery that follows is violent and fast. Now, let me tell you what 2 very different operators are doing in the same market. MicroStrategy has been buying Bitcoin every single week for 13 consecutive weeks. Never stopped. Not when Bitcoin fell from 109,000 to 62,000. Not once. That is a man who knows exactly what he owns. Then there is BitDeer, who just became the first major public miner to hit 0 Bitcoin holdings. They liquidated every single coin they had. That is not conviction selling. That is a shop that ran out of cash and had to strip the parts off the race car to keep the lights on. Eventually, the forced sellers run out of inventory. When they do, the buyers are still there and the equation shifts fast. Now the liquidation map. This is where we talk about where the charges are buried in this market and what detonates them.